Scott Martin, Market Watcher of the Day, is with us. Scott, I think this market wants a gigantic stimulus package, and they're holding out for it. What do you say?
Yes, I agree, Stuart, and I believe that the Fed also, or rather, the market also wants to see Fed intervention, which is just days away, as well as more coordinated central bank intervention. I mean, I know that we've started that process, but I don't believe that's finishing yet. And listen, with these markets too, Stuart, just quickly, are not trading on any fundamentals. I mean, the fundamentals are out of the bathwater. They're away from the baby. They've gone out the window. The market is trading on sheer panic right now, sheer fear, and sheer expectation that the worst case scenario is going to come possible. So just something to keep in mind as you're an investor here. If you're looking to rebalance or change up your investments, just know that you're doing that in an irrational market.
Okay, Ray, still with us. Does this remind you at all of 2008?
It kind of does, but here's the thing. There's an end to this, right? You know there's going to be an end in the transmission. It's going to take about 4 to 6 weeks if we go through this, and there's that piece. But the uncertainty between now and the next 6 weeks is all about supply side versus demand side.
All right, 10 seconds to go, and we'll open this market. When you look at the futures, you'll see they are limit down. The futures contracts are limited to a 5% loss. The market is about to open, and we're going to show you the S&P 500. If that goes down 7%, when it opens up, you'll see some movement. If we get a minus 7%, this market will be halted for 15 minutes. That's what you've got to look at, the percentage decline of the S&P 500. Right now, it's down 6.59%. If it goes down 7%, watch out. That market closes for 15 minutes, just as it did, what was it, 3 days ago?
Yeah, so first time in 1997 the circuit breakers actually kicked into the market.
Yep.
But, you know, we should be careful about this. You know, is it 2008? We haven't seen any companies go under. There has been no Lehman's. There has been no Bear Stearns. I think we need to caution that with a little bit more.
No, well said.
Yeah.
Well said.
I also think that circuit breaker that we saw just earlier this week worked quite well. It really did. Gave people time to take a deep breath, the buyers and the sellers to reevaluate. And after they came back online, we didn't see that dramatic drop.
So now we're down 6.59%. We've been at that level for some time, 6.53%. You don't close the market for 15 minutes unless the S&P goes down 7%.
Fastest bear market in history. In 1929, it took 42 days. This time around, it took less than a month to lose 20% from recent highs. So it was a great bull market run. 11 years, 2 days. You made $20 trillion and over 500%, but it's now come to an end.
Okay, now we're very much aware of what's on the S&P. We'll keep you informed on that. I'm going to bring you up to speed on some of the other stuff that's going on. The NASDAQ composite, have we got that? Yeah, look at the NASDAQ. That's down 6.5%. Pretty much a consistent down 6.5% across the board. What do you have?
S&P now down more than 20% from the Feb 19th high, so the S&P in bear territory as well.
In bear territory.
Yes.
But it's not down 7% today, so it's not closing the market yet.
Well, it's 20% down from its February 19th high.
That's a bear market.
That's a bear market.
In fact, I looked this morning at an index of all the world's markets, and it is down 20% down. That's a bear market, absolutely globally on average. Quickly, the anxiety indicator, that's the 10-year Treasury, 0.67% this morning. So money is going into safe treasuries. Gold down 36 bucks.
Yeah.
I find that fascinating. I've got an explanation. How about this? People are selling gold. They may have made a small profit. They're selling gold to meet margin calls on their stocks, because they bought stocks on margin. They borrowed the money to do it. And as the price of the stock goes down, the broker calls them up and says, hey, you've got to jack in some more money, please, and we want it. So where do they get the money from? Some of them are getting it from gold, down $37 as we speak. Yes?
We also got some disappointment from the ECB. They were expected to cut interest rates further from negative 0.5%. They didn't do that, unfortunately.
But they are going to jack a lot of money in.
They are. They're buying bonds, offering very cheap loans. But still, the fact that they didn't cut the headline rate was a bit disappointing.
I consider that a negative. What you're seeing on your screen now, $30 per barrel for oil, down $2, down 7%. That means an awful lot of drillers and the people who produce the oil in our country, they've got an extended credit line. They're being called on that credit line. They're awfully close to having no money left to pay down their securities. When you've got oil at $30 a barrel, you got a problem.
There's
Susan,
a lot of people that have some credit concerns. Yesterday we talked about Boeing, that they said they would use up that $13 billion loan by this Friday, possibly. Also, Hilton Worldwide lost 9% because they said that they would draw down some of its credit line. In fact, Blackstone, which owns a lot of companies because it is a private equity fund, they actually have been advising the companies that they own, draw down some of your credit so you don't have a liquidity crunch. And that has people concerned. I think that's a comparison of 2008.
Exactly right. That's what I was getting at.
Yeah.
There is the beginnings of a liquidity credit crunch.
Right. Yep.
Not a crisis, but there's the beginnings of it. And that makes the whole financial system shaky. And that has a lot of people rather worried.
Which is why we want coordination from central banks, to Scott's point. I mean, that's what we want to see.
Yep. Okay, Scott Martin, you got real concerns here about a credit crunch and shaky financial markets?
Yeah, there's just some. But you guys are doing the terminology correct. It's not a credit crisis, it's a crunch. And as Susan and Ashley pointed out there, once they draw down these credit lines and go through that credit, what happens? You know, when you go back to the bank and say, hey, our revenues have fallen 30%, and we see maybe the light at the end of the tunnel, but for the next 3 months, we need more credit. And that's where, guys, the difference to me is 2008 versus now. Now the administration, now officials are meeting with banks. They're getting ahead of, I think, what is this impending issue with other containment and other issues that are going to come with the virus as far as quarantines and stuff. So they are talking already to the banks saying, we got your back if you can go ahead and not pull these loans in and give credit to businesses that need it.
All right, left-hand side of the screen, and this is for our radio listeners.